The secret investments of the 1%. Now, is there really this hidden world of investments that the 1% all play in? Well, yes, there is, but it's not quite what you think. So, first of all, when people say things about the secret dealings of the 1%, it's not that it's because the 1% are a part of this group and they're hoarding all the investments to themselves and they get things that are not offered to other people because they want to keep it all to themselves. That's not true at all. In fact, it's quite the opposite. But yes, there is secret investments of the 1%. Yes, they do get investments, and they see investments that the 99% do not. Why is that? And how come there is this other world of investments and assets that are traded that are not common knowledge to the rest of America? Well, we got to go back, way back, like back to the 1930s kind of back. Now, there was a few things happening in the early 1930s, and none of them were good. This is the Depression, and the Depression just rocked the very foundations of America's financial well-being. Banks were going under. America was not prepared. Now, throughout the 1920s, people poured their money into the stock market because everybody was getting rich. It was just so easy. Well, all good things have to come to an end, and it did in the late 1920s, and the bubble burst. Now, the stock market burst caused something else, a run on the banks. We didn't have a lot of the laws like we do now that protect and insure our money. So everyone was afraid that there'd be no money in the banks. And that was a real legitimate fear because it happened. And banks started to fail. The whole financial system in the United States began to crumble. As all of this was happening, the government needed to protect U.S. investors. The 1933 Securities Act was designed to protect Americans and their investments. Now, prior to this, it was the wild, wild west. You could do anything. All right, not anything, but you get the idea. In order to protect the American investor, they wanted to make sure that there was a well-regulated market. This became the public markets. Reg D was designed to protect investors from private securities. Those are securities that weren't as regulated as the public markets. The view was to help non-sophisticated investors not get into a private security that they didn't understand. But private securities is just an investment or an asset that is being offered by a private company, not a public company. Really, that's kind of it in its simplest form. But at the end of the day, a private security doesn't mean that the money's pooled together. It's just a private offering. People can pool their money together. They can do it individually if they want. But they have to abide by the SEC's laws and regulations. And in order to make sure that this happens, they had to put qualifications on individuals that can engage in these private markets. The criteria that the government set forth was this. You need $1 million in today investable assets. As an individual, you need to make $200,000 plus, or as a family, $300,000 plus. And a professional status, like you have your Series 6, or maybe a family office. But there's a professional status qualification that the government approves you to be an accredited investor.
3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We read everywhere.
Now, in 2008, once again, we had a great bubble burst. Now, this time it was in housing, particularly single-family homes. The most wealth of the average American is held in their home. In 2008, that was eradicated. Now, the build-up to 2008 also made a lot of accredited investors because the housing price, as it bubbled up and up and up, that was added to their net worth. of investable assets, that $1 million qualification for an accredited investor. So the government issued what is called Dodd-Frank. Now, Dodd-Frank states, particularly in this case, that you can no longer use your home as part of your net worth to qualify. They added on the investable assets, meaning you have to have $1 million that you can actively invest. That may be in stocks or investment products or in cash, but it can't be your primary resident. It was this classification of sophisticated investors or accredited investors that the government has set forth. Now, that created a separate market from the public markets. And the rules that dictate the private market are very rigid on things like soliciting. So that means you don't talk about it. Stay quiet. You can't be out pitching your deal unless you have direct knowledge that they are accredited investors. And the laws are very, very strict on this. So nobody wants to break them. That means that those private markets have become kind of secret markets. We kind of know that they exist, but we don't really see what's happening. We don't really know what's going on in them. And the reason is, it's against the law. So the secret investments of the 1% are direct ownership and placement of private opportunities or investments. Now, this is all done and communicated between the rich because they're all accredited investors. But it's not because they necessarily don't want to talk about it, it's because they can't. But at the end of the day, it's actually quite simple. I mean, people like even I engage in this. You get private people that want to invest all together, and you go out and you buy assets that everyone can participate in. This is something that is done at massive magnitude. The introduction of the fund structure completely changed the financial landscape of the United States, where they began pooling together at mass accredited investors. And then private equity, hedge funds, all of those came about. So does this mean that as a non-accredited investor, you can never invest like the 1%? Not at all. It means that you're not going to be offered certain types of investments. But if you're not a part of a fund that buys storage facilities, that doesn't mean that you can't go out and buy storage facilities. It doesn't mean that you can't take your family members and a best friend and pool your money together, create an LLC, and go acquire that asset. When we got started, we didn't invest in funds or with the accredited. We started small. We bought small storage facilities that we directly participated in a private investment. Now, we created it, we worked hard for it, we didn't invest with somebody else that was going to do it. So there is a little more work, but we could still do it. It's important to watch closely what's going on in the private markets and what the rich or the 1% are investing in. What kind of strategies are going on? What are these funds participating in? What data are they looking at? And then you can follow in their suit and mimic that same thing. So what do you think about the accredited investor status? Do you think that the government should pose regulations and constraints on individuals and what they can invest in? And what questions do you have about investing as an accredited investor and non-accredited investor? Let me know below. All right, thanks everybody for watching this video. Don't forget to like, subscribe. It helps me out a lot, and we'll see you next time.